One thing that at the outset, some people are going to react to this very mathematically designed tee that I'm wearing, but it got pushed to me when I was at the one of the malls, and they had a smaller size, and they finally found one, and I said, fine, then if it fits, I'm going to take it, because that's a lot of what we do, right? Technical work, technical analysis, indicators, data, all driven by some kind of number crunching, some kind of statistics that we try to put onto the market and get an answer as to where we are and where we are headed to next. Now, for those of you who've been missing Jay and Muskan, Jay's on a well-deserved long holiday. He'll probably come back after a week. So until next weekend, you're not going to be seeing his midweek update. But here is mine. I haven't spoken in a while, at least on this platform, but I hope everybody's caught the long shot webinar. I've had raving reviews, a lot of very good appreciation and comments coming back to me because we made it free, which is when everybody gets to see the kind of work we do and the kind of depth that we really go into to explain what the markets are doing. Because purely on one part of the market science, if you're only looking at technicals or only looking at fundamentals, you understand some bits of macro and you're reading the news. If rates go up, this will happen, or inflation comes down, this will happen. And all those narratives completely confuse you. The hard part is really joining the dots, something that I spent more than a decade trying to do. Even though I was doing it for 2 decades, but the last decade was, especially 2010 to 2020 was really important before, I quit my 18 years at Sher Khan and got down to this where I spent time looking at global macro. So I was mostly looking at India. I had a view in 2001 that, a new bull market would start, essentially on a very simple idea that interest rates were coming down significantly more than we had ever seen, and that Indian core sectors, economic sectors, had gone through a 10-year consolidation. Now, after that, I had to think about many more things in terms of the long wave. Very little material was really there. And so I wrote my own note, taking the basic factors from 2011 onwards, and writing that note on the quantitative cycle. All the papers are online. They're completely free to read. So if you haven't seen those also, just go to Indiacharts and look at economic updates, Indian economic update, and there's something known as winter updates. The winter updates are just, time to time posts on different news articles and items that we discover. But the Indian economic analysis is where you'll find 3 to 4 reports on the long wave that I wrote from 2011 onwards. Last updated, I think, was in 2019. And since then, now I've been saying that, we come to the end of winter and into spring, which is where I need to rewrite from a spring perspective. And these are very long data points. They last multi-year, which is why I'm waiting to let the data evolve. And there's a theory behind it, which I'm seeing in the markets play out. So, it's one thing to think that, okay, this is what might happen, and another to see it play out and then confirm that, yeah, this is what is happening. And so that is probably another reason why I never ended up writing the spring notes after winter, because the long wave actually occurs only once in your lifetime. It's like a 70, 80, 90 year kind of a cycle. Used to be 50 years, but even 50 years is once in a lifetime. And imagine you figure out about this cycle when you're 25 and you spend 50 years. By the time you're like 75, 80 and you're done with your lifetime, you've seen one cycle. And if you're born somewhere in between, then you haven't even seen the whole. So nobody can really have a memory of the entire cycle. You can only study the past and try to extrapolate it in the future. And because it's a cycle of events and not time, if it extends in time, which is what has happened in the last century, because what used to be studied, originally was studied by Nikolai Kondrateyev as 50 years, has now become 80, 90 years, 100 years for the US. And therefore, we're only looking at those data points based on what has happened in a previous lifetime and try to putting it together in our lifetime. So that's what I tried to do. And only by doing it do I get a better idea of how these factors are moving, why they are moving, what impact they have, and then finding the right actors online on YouTube and other places to read the right research guys who have the right views on these factors was another exercise. Because the first thing that happens when you end up going on YouTube is you end up with all the conspiracy theorists and gold bugs. Now, gold bugs are a good place to learn, but they are perma bull gold and perma bearish markets, which is also not correct. And so, but their analysis really helps you dive deep into each of the parameters that go into that analysis. So the parameter reading and learning process is good, but don't get stuck with those views. Learn how to interpret those, parameters in different market environments where you have to be both bullish and bearish, and that's when your schooling or learning of this entire exercise is done. So anyway, You can go to YouTube and see the long shot webinar recording. It's also there on Twitter and most platforms because we did it live. And so it got live recorded on each platform. And so the live recordings are there on every social media. But if you like YouTube, you'll find it over there. So you can just see the historical videos of Indiacharts on the Indiacharts channel and see them there. Also, don't forget to subscribe to the channel for future updates like this one if you haven't already done so. So anyway, Jay and Muskan return later. What I'll do is spend some time on the Nifty itself and then talk about various other things that have happened this week, including the Fed. So what the Nifty has done after the Fed, because that's the market that really concerns us, is two things have happened since we wrote the long short report. First is it hit 19,990. Now, if you remember, in the report I wrote about B waves, right? B waves that occur in expanded flats, they can actually go way beyond the previous high up to 138.2%. Okay, now I do think whatever has started from March of this year, March of 2023, is a new leg of a bull run, and therefore I don't think it's a B wave. But it's important to discuss these levels because a lot of people who have different views, different readings of the same market up to a certain point of time need to agree or disagree on it. And this is an important level for that, which is 19,910 is the more exact level. I was calculating it yesterday. And you can put a 100-point rub off. Say if you cross 20,000, you can say that it's no more a B wave of an expanded flat, which means you cannot call it a bear market rally from an Elliott wave perspective. Okay, so we are talking about Elliott waves. And so we are talking about Elliott waves. You want to put that in quotes. From an Elliott wave perspective, this is not a B wave if you cross 19,910 on a closing basis. Okay, and if you trade above that for a while and you go above 20,000, you can very well say it's not that, and you have confirmed that yes, this is a larger bull run. My confirmation, I've explained in the reports, has been more driven by the dollar and by the structure of the market itself and the way stocks have behaved. That has been the main driving force behind our views. So we stopped there, which is important because we've actually given respect to the 19,900, 990 level, that range which I'm talking of, and respecting it once is good. The next thing that we want to see is actually getting past that, which I think it will happen. Let's see if it does. But we've pulled back. So since we wrote the report, we've pulled back. In fact, somebody was highlighting it to me on Twitter that since you wrote the last two reports, the markets went the other way. I said, yes, in the short term for 4-5 days they did, but eventually what we are seeing has played out. And that's sort of the pattern we are seeing also here. Because by the time I'm writing, I'm sort of confirming certain things. And when they confirm, it's like prices have moved and then they're pulling back. So that's fine. This pullback so far has retraced around 61%, 66% of the last 6-7 day rally that we saw from around, around 19,300, 400 from where it went up, and or 19,200, and then it hit 1990, you do a 61%, you come to close to around 19,600. We just went a little below that maybe today, and so that's where I am saying even 66%, and then you're within that range, 61 to 66. Good support for a normal wave 1, wave 2 retracement and continuation of a minor degree 1 and 2. And same thing in Bank Nifty. If we take this entire rally that has taken place over the last, I think, month or so, I think since where it was 44,000 something, that also has pulled back quite a bit. We are back to the 20-day average, I think, on both the Nifty and Bank Nifty. But Bank Nifty also, I think the last 7-day rally, which it saw in July, that rally has been retraced by 61% also today. Okay, so both the indices sort of doing that 61%. Initially, it was not looking like both will do because Nifty fell first and was almost at 50-60%, whereas Bank Nifty was still at 23-38%. So it looked like, okay, both won't do it. Maybe this will reverse and that won't. That's what I thought yesterday in my updates. But finally, both have done 61%, 66%. And that leaves us this week, as this week has closed, with a negative, with a down week in expiry at the end of what was a very good month. Because at the beginning of the month, if you've used Strike, now for everybody who's not yet used Strike, again I'm promoting web.strike.money. That's our new tech platform. We've really not advertised it a lot. So whoever's hearing about this, you're the new guys who will hear about it. You'll be the first ones to observe what we have done. Because all this data, everything that I talk about, all the sentiment indicators I use, everything is there for all of you to use yourself and see. So why would you miss out that opportunity? And this is still 30% of what we have done. By the time, in another month, you'll see, a dozen to 2 dozen more features showing up across analytical tools, whether it's fundamental, economic, whatever. We'll keep adding and we'll keep improvising based on the feedback that we get from you guys that, this is how we want to use this platform, this is how we want to use this particular tool. And we're already making those changes rapidly with our mentorship group who's inside with us, giving us feedback on a day-to-day basis, plus all the tickets that people are raising. So there's a lot of happening. But what I was referring to right now, which you can go and check there, is the indications from positioning. You can see the FIA positioning, what really ended up happening over there. So you can see the seasonality. The seasonality for the month of July was actually one of the best months of the year based on the last 10 years of history. And that's what it has ended up being even this time. The returns for July in terms of the Nifty are still pretty good. Of course, the month ends on Monday. So if the market does bounce back from this retracement level, the return would further improve and therefore it would fit the monthly return. Even though on an expiry basis, you did come down in the last 1 week, which sort of pushes you back on an expiry to expiry basis, which is again a different analysis. Now that's another input. Some people might say, why don't we look at expiry to expiry returns? May give a slightly different picture. Yeah, that's another angle of completely looking at it. But if you want to do it that way, what we have is heat maps where you can actually put dates and to look at expiry to expiry returns for any index or any stock. So that's how interesting it is. You can even take your FNO stocks and do that with the FNO basket. So again, get back, start using the platform. You can see the FIA positioning. 3 days ago, before expiry, it had reached more than 1 lakh contracts, and the last dozen times that we got close to this level, the markets have either paused, corrected, or even fallen quite a bit. Now, how much they fall depends on, of course, where you are in the overall market structure. So you just can't look at a number and say it's going to fall a lot, because 21-22 was a corrective phase where you got bigger declines. Similar readings, if you go back to 2020, you didn't get that big decline. So I would consider this more in comparison with 2020 and 21, where the pullbacks were purely, a few percentage points, maybe back to the averages, some retracement, and then again you continued higher. And post-expiry, FIA positions as of yesterday had already dropped back to 33,000 contracts from 104,000. So almost 70,000 contracts given up on expiry itself. So FIs didn't want to hold on to those longs, but that reduction in position sort of does away with the corrective process, So they don't really need to fall anymore if the larger bullish trend is intact. In fact, today's fall might have further reduced. We need to see the end of day data comes from NSE around 7:30. Then we update it on the platform later in the night. And worst case, if for some reason by morning. So it's usually there in the night, late night. If you see, it will be updated. You'll see how much further it has reduced today, if at all, after today's decline in the market. But we are at, like I said, levels, key important support levels from where I would think that if the trend is intact, we should resume the upward trend right away. So what was this 2-3 day volatility all about? Of course, this was a central bank heavy week. Okay, from global central banks, you had the Fed, ECB, and Bank of Japan, BOJ, all of them coming together with them. Now, they've been doing this, I think, so many times that all three come back to back. And they sort of have, I'm sure they've all planned and they all know what each other is going to do. And they plan it in a way such that it has a particular impact on currency markets, because currency markets are key. You don't really want them to fall apart when you're taking interest rate decisions, even though. And it really surprised me. I was telling this, speaking to one of the senior editors at ET Prime that, the RBI made the statement saying that interest rates are not a policy tool for currency management. Very, very surprising. When the currency starts falling apart, what do? You raise interest rates. So for them to make a statement like that it didn't make sense to me. It's basic Forex classroom. It's called interest rate parity. It's one of the factors that is thought when you actually think about Forex market valuation. And if you're trying to do some kind of number analysis on the Forex side, you would actually start thinking of things like that. So how can you not pay attention to interest rates? So interest rates do play a role. And therefore you start thinking, is the dollar going to get strong or is it going to get weak? Now just see the funny reaction. The first thing that happened is that the dollar actually started to fall after the Fed's announcement of 25 basis points rate hike. Okay, now you'd think, it's a rate hike, the dollar should go up. It goes the other way, because a lot of people are positioned in a particular direction, and so many news reports were there days ahead of the Fed meeting itself said the Fed will raise rates. I was not expecting it. I thought they'll follow the inflation data. There's so much reduction in inflation. Why do you want to squeeze further? But they know something that we don't, which I'll come to, which is the GDP data. And so maybe they thought we have room to squeeze a little more out of this, some more juice out of this. So they went ahead and did that anyway. But having said that, people may have bet on that idea, right? That they're going to raise, and the media is saying it, and they're bets. And then once they do it, there's profit booking and the dollar fell. And then you have the ECB raising rates, which also I would think is dollar negative, but it started to reverse from there, because the moment the ECB raises rates, it means the euro should be stronger, right? And again, so you're seeing a lot of this volatility happen very short term, which may have to do with the near-term positions of people. I don't think these are what set the trend, okay? So this is where if you try so much fine-tuning as whatever I'm talking, this means this and that means that, that's just for the day, After that, the larger trend takes force, and that larger trend is based on macro, based on really where things are eventually going to head 6 months down the line. So we'll come to that. The last one was Bank of Japan, and people are asking me, what did this mean? Because what did this yield curve turn mean? And then there are media reports which are saying, oh, well, Bank of Japan did this, the yen crashed. I mean, like there was just some intraday bar which went like this. And they've made it a yen crash as if it lost like 4-5 points in a particular direction. It went from 140 to 145. I'd call that a yen crash. It goes from 140 to 140.5 or something like that, intraday gyrating within a 1 point move. You don't call that a crash of a currency. But media has to say something. If you don't say crash, you won't get clicks and headlines. And it's unfortunately become like that. But what did this really mean? What did Bank of Japan just do? They didn't say they're going to stop buying bonds. So that means the yen should still weaken. All they said is that instead of buying it at 0.25%, we might buy it at 1%. So we change the level at which we'll buy. If the bond market wants to fall a little more, they're free to fall. We'll buy a little higher rate. So we're not going to stop financing the bonds, right? We have to do that because they're government bonds. They cannot default. But the change in that rate range is a way of policy tightening or indicating to the market that, well, we are okay with slightly higher interest rates because our inflation target has also moved up above 2.5%. Unlike what we thought it wouldn't go that far. Now it's going, so we widened our rate range. So here you have global central banks widening their rate ranges with a huge lag to the US central bank. Now this is the important part when you're trying to think about where currencies are eventually headed. The US is closer and closer to the end of its hiking cycle. The others are somewhere midway. ECB started months later than the US, and so they're still trying to hike. The inflation had gone to almost 10%. Now ECB is at 3 point something on the rate. So they actually have negative real interest rates in Europe, and you have positive real interest rates in the US. Now you would say, well, if that's so, then maybe the dollar should be stronger. But in terms of actual rate differential, can be different. And because you're at different points of the cycle, that is the real driver. If you think 6 months down the line and you say, okay, the rates are going up, they may go up once more, just going by what the Fed is saying. But if inflation falls very fast, they won't even go up once more. Eventually, they'll be lower. Okay, so they're going to eventually cut rates following the drowning of inflation. Okay, till inflation rebounds, if it does next year. That's another story. People are talking about it. Let's not talk about what will happen after 12 months. I mean, we're talking about 6 months first. First, let this happen, which is the US cycle turning down. The Europe rate cycle is still going up because there's still negative real interest rates and inflation is still sticky. And then you have the Japanese cycle saying, oh yeah, we won't do anything. And now they're finally having to do something. They finally moved for the first time. Will they have to move a few more times? And so now you have different countries which will be tightening even as the US gets closer to easing. Now you understand what the difference is. The difference is that means the currencies that are still tightening get stronger versus the US dollar. So the US dollar weakening trend, which started last year, when who intervened first? If you guessed it, you're right. Otherwise, you can do some homework, and it was the British pound. It was Great Britain when they faced that crisis with the insurance sector's bonds because bond yields had gone up and they couldn't finance it because there was some leverage on their books. And when they bailed it out, the pound stopped falling and started to appreciate. And it has been appreciating and leading this move of the dollar down. So the pound has been the strongest, I think, among all the advanced currencies that are out there, advanced market currencies. It has moved up the most against the dollar. The others are lagging behind and slowly getting there. The euro has now turned and showing signs that, yeah, okay, I'm going there. The yen and the yuan, which is Japan and China, were lagging behind, which I think are now starting to do so because they've done a good 80% retracement, and now it's time for them also to get stronger. And these moves that they're doing should eventually strengthen their currencies and not weaken them against the dollar. And so therefore, what I think of the last 3 days movements in the dollar, it fell after the Fed and then it made a higher high. It's only reached 61% retracement of the fall we saw in July, okay, late June to July bottom. And that's where we are close to, and I think the 20-week average is around 102.4 or 2.5. Somewhere there, the dollar tops out and starts, or it may even top out here at 61% and start rolling over to the downside. Give it a few days and it'll start happening. And I think that is the bigger backdrop. Nothing changes, nothing that has happened in the current Fed policy changes the direction of equity markets as such. Okay, because very simple metric, right? If you've seen the long short webinar, we've spoken about the dollar. The dollar is falling, or it's going to fall on a 1 month, 2 month, 3 month basis. It's going to make the environment easier for emerging markets, and that's just the simple theory. Dimag nahi lagane ka, the bull market remains intact. Unless something breaks, nothing is broken. US market had some day-to-day volatility. None of the US indices have still even closed below the 20-day average. I mean, just like in India, and so there's a lot of strength driven by something else which is called liquidity. Now, liquidity is another interesting factor. Most people say liquidity is just reserves, and I couldn't get my head around that. And in the last 6 months, people started saying, okay, global reserves. Now, that's interesting. One step further, we learn a little more. And then I came across, 6 months ago, cross-border capital. I had read about them before, heard about them before, but probably not tracked his data more closely than now because I really wanted a good indication of what should really liquidity be. And they've built their own indicators. You can find them on Twitter, where they're measuring many more metrics than just central bank liquidity, many other things put together and trying to capture liquidity cycles. And essentially from October of last year, where the US markets bottomed, the liquidity cycle was at the bottom end of the curve and is slowly turning up. And these cycles last for 50, 60 months. And that means you have a good 1-2 years of rising liquidity, and before that peaks long way. Now, what are the components? What do they discuss? There's a very interesting interview I came across today with Michael Howell and one more gentleman who are just talking about this subject and explaining. So if you really want to increase your knowledge on it, I will share the video. I'll send it on the emailing list, whoever on my long-term mail, free newsletter mailing list, which is managed by Aweber. That mailing list, if you are on, not just subscriber, that's like the free mailing list. If you haven't heard about it, it's been like more than a decade since I've been keeping people updated on email the very old way. I will send out that video so that you can look at it and update yourself. Maybe I'll put it on social media as well. But that is what I think you should do if you want to understand this subject better. Listen to these gentlemen and probably tell you a lot more about how you calculate liquidity, what are all the multiple factors that go into it, not just one or two. And that sort of gives you the overall model, because that is what drives the markets in the near term. The fundamentals eventually long term play a role in justifying what has happened, but in the near term, liquidity plays an important role. So this is what I'm telling you is the net conclusion of a couple of discussions that are interesting and good discussions that I was listening to. And so I've just sort of shared you the same. You see, every thought of mine is not always mine. I do have thoughts on charts, but I look for information and data which sort of tells me why certain things are happening and why they are likely to play out in a certain way. And if something changes, then I know, okay, this narrative is breaking down. You need to look for another narrative. And that's I think the task of a market strategist or a market analyst, as I think about the work that I try to do, that you got to look at all these things and put it all together. It's got to be a complete market science. It's not just about one thing. The charts are very helpful because wave analysis can be done on interest rate charts. It can be done on currencies, and you can have a better view of what is happening in those markets when you're actually trying to discount the fundamentals along with what is happening on the chart itself. And so that's how you combine all of this together. And then, of course, some knowledge of economics to be able to add that, this factor with this factor makes sense or it doesn't. And having been a student of, economics and commerce and management, I think I've built my sense of that, and a lot by reading. So reading is definitely a big way of doing it. There's not everything that you can know just from books and study. You have to actually read some real work and see things happening in real time for maybe 5 to 10 years. It helps you gather that much understanding of this subject. But start, because if you don't start, you won't really move ahead on that thinking. So this is, I think, the overall picture, what has happened this week. The markets have had a correction. They're back to key support levels from where I believe they should move up again. And all the central bank action is still supportive of a weak dollar environment in the months ahead, even though the short term, we are seeing some spikes going around. And I think the setup across commodities remains the same. Even after this week's volatility, nothing has really changed. So that sort of gives you the overall picture of how things are set up. But we are getting to the end of, not completely the end, but more than halfway through this earnings season. Some people are saying it's flattish for now. Better for some sectors, not so good for others. And wherever it's not so good, what I've been highlighting is these are the late cycle sectors, right? The ones that were under pressure because of this interest rate policy, which is basically commodity related, whether it's oil and gas, whether it's metals. These are the sectors that are reporting poor numbers. The ones that are reporting good numbers, financials, auto. So there is this divergence, even FMCG, they're all reporting good numbers. So just because there's this divergence, you can't say, oh, this is all bad. The sectors that are reporting poorer numbers still are because that sector was still in a downdraft. We are waiting for it to pick up. And definitely you don't get good news at the bottom, right? This is how I justify it. You don't expect Reliance to report fantastic results because it just bottomed and is turning around. It doesn't work like that. It's down because there was something wrong, and the results just justify the past price action. They don't tell you anything about the future. Sometimes even the management doesn't know about the future. The charts know better, and that's something you have to learn, because charts are more broad psychology and herding instinct of not just what is related to a particular company, but also sometimes the economy as a whole. And especially since I mentioned the name of Reliance, it is a large part of the economy, right? At one point they were like 5% of GDP or something. 5-6 years ago it was reported. Maybe a different number, but when you're such a big company that you're a certain percentage of GDP, the broad economy and the cycles have a direct impact on what is happening to you. So you're no more just an independent company where you can move in a particular direction without without any concern of what is happening at the broad level. And therefore your prices also reflect the macro changes that are really happening below the surface. And that's the reason why the chart sometimes know some things that even sometimes the companies don't know. Is why I say that is it does happen, especially in well capitalized and companies that have been established in a particular sector. So that's the approach. Things are getting better step by step, stage by stage, and it's probably still too early to say that this is too much, this is done. I mean, just one thing that people talk about, valuations a lot. Valuations are high. They may be high in one particular sector, one particular stock. Like you're seeing chemicals got super highly valued, not performing, right? So it can happen to a particular sector. That doesn't mean the whole market, because if you're doing whole market, then you study the valuation of the whole market. And the whole market P ratio is what? At the bottom of March, 18 times. Bottom of COVID, 17 times. Now I know it's consolidated, and earlier it was non-consolidated. You can do that 20% variation to the P ratio because of that. But in either case, that means that would only mean that the previous P also would drop below 17. But even now, you're not back to the peak range, which is closer to 30. You're somewhere at 22, 23. And so you still have that much more room on the upside if you have to go to peak valuation where you start saying, oh, now it's entering bubble territory. So we are not there yet on an overall basis. There may be one sector which is up there, but our PSU stocks in overvalued territory, they're still high dividend yield stocks despite the recent moves. And so it's very, very different environment. And of course, the valuation base at which markets bottomed is determined by where interest rates are. The last time P ratios would have dropped to 10x, interest rates in India would have been 9%. So now if you're not going above 5-6%, then you're expecting the P ratio to go back to 10x. It's sort of not logical from an interest rate valuation, comparison perspective. So that's another thing to understand and keep in your mind. A lot of things I've probably tried to tell you to think about when you think of these markets, and why this is just the curve. It's beginning to happen. You're seeing more and more participation from different sectors. Like I spoke of a couple of cyclical sectors that are just basing out in terms of their numbers, and those numbers start improving, those sectors start doing well. We'll have completely different environment 6 months from now, and that is what markets are anticipating and continuing to move ahead on. And as I midway said, it's also driven by liquidity expansion. This is at a global level. At an India level, somewhere you will see that only when probably RBI changes its policy stance. One last data point, the last 3 months you have seen WPI inflation really turn negative, even though CPI is still coming down, but not yet in RBI's target range. But when you're at such low levels, it is indicating that things have really slowed down and tightened. But the RBI will wait. It will wait because global central banks are moving in a particular direction, and you want to keep balance with that just for the sake of currency markets. And I think that is the reason why they are not in a hurry to really start cutting. But 6 months down the line, I do see interest rates in India turning lower eventually, and bond markets will probably lead that signal. They've already broken down from a triangular pattern. I'm just waiting for the next wave down to start for bond yields when they'll drop below 7%, and you'll see it at 6.5 and 6.2. I don't know if that will happen by December, Jan, whatever that time frame is, and that's when I think markets will start bracing that in terms of what is really happening on the liquidity front. So from an India perspective. So that's it. That's my update for you today. A lot to think about and take away. Until next time. Thank you.